It's time to define a marketing term. Commodity broker, analyst, and author of Mastering the Grain Markets, Elaine Kub joins us. She believes the key to profitable grain trading is building knowledge about the fundamental practices of the industry. Today, she helps us define the word hedge. Here's one definition: to protect one's investment or an investor against loss by making balancing or compensating contracts or transactions. Elaine, how would you define hedge?
I think that's a great definition, and I think the word that helps me understand hedging best or helps others understanding it is the word offsetting. It's the practice of making an offsetting trade that will financially reimburse you if the market moves. So you're right. A farmer may not think of his field of corn as an investment, but it is. He's put a lot of time and a lot of input cost into it. So to offset a growing field of corn, he could sell corn in the future, for instance. So that way, if the market goes up, his sale on a futures market or on a forward contract, that sale will lose financial value, but the cash corn itself will gain value. So you have two offsetting trades, effectively like the spread trades we talked about a couple of weeks ago. You have two trades that one will exactly offset the other, and then you have a perfect hedge.
A perfect hedge, and the hedge is lifted when?
When you go to sell that cash corn, you're right. To be a perfect hedge, you have to instantaneously pull off your offsetting trade, which may be a short futures contract, for instance. And to be a perfect hedge, you also have to have the same number of bushels, which is really hard to do when these futures are in 5,000 bushel increments or 1,000 bushel increments. So perfect hedges are more theoretical than practical, but that's always the goal to limit your risk.
And so a hedge, in all honesty, is trying to limit the risk on the total number of bushels or on a number of bushels. It may not be the total number of bushels over time, and it is different than speculating?
Yes, absolutely. A speculation is you're embracing risk. You're taking on risk and you're trying to participate in the market as it moves. The more the market moves, the more you gain. A hedge, you're trying to limit your risk. You're trying to lock in a specific price so that no matter what the market does, you know what price you're going to receive by the time you add up the profit and the loss on the two offsetting positions.
Wait, how do you do that? Explain how the hedge limits the risk.
Okay, so let's say you've got a bin full of soybeans right now, and soybeans right now are worth, let's say, about $14 in the cash market where you are, and you like that price. You want to sell your soybeans for $14, but you don't know where specifically you want to take the physical soybeans. So you could continue to own long cash soybeans, and you could sell an equivalent number of futures contracts at $14.41 today. So as the market progresses, let's say next week, the futures market is all of a sudden $15. Your futures position will be a loss. You will end up writing a check to the exchange or to your broker for the financial loss that you have on your short futures position. But then when you go to physically sell your physical soybeans, you'll receive relatively more money for them. So there'll always be one profitable position and one unprofitable position in a hedge because they're offsetting their opposite trades. But the idea is then that no matter what happens to the market, you will receive the equivalent of $14 per bushel.
That's commodity broker, analyst, and author of Mastering the Grain Markets, Elaine Kub. Today, she defined the word hedge. I'm University of Illinois Extension's Todd Gleason.